Pankaj, he asks, which is riskier, a small cap fund or a thematic fund over 5 to 7 year period?
Uh, they are very different. Some thematic funds are basically a theme. It's not a specific sector. It's not a kind of fund which is investing in a certain capitalization. So if the theme works, it works wonder for you. If you remember, somebody who invested in 2004 or 2005 in the early infrastructure funds, it did wonders for their portfolio. And when the tide turned, the theme actually went out of favor. And unfortunately, the investor behavior is very unfavorable. Investors generally tend to invest in anything which has already gone up, not necessarily when something is going to go up. So anything which is out of favor but it is likely to do very well in future, that thing investors don't really understand. Or it is a very difficult decision to invest. It amounts to buying low and waiting for it to actually gain currency or gain acceptance and then selling high. As compared to that, smaller companies, the story is different. They are small companies, they have small income, they have small profits, and if they are good, they can actually grow faster. Large companies can't grow at the same rate as a small company can. And the growth rate can be higher, so the stock prices actually get, gets rewarding. If a company is growing at a 25% annual rate, which a small company can, then it turns out to be extremely rewarding for investors because the earnings going up by 25%. But for a large company, that gets very difficult. And if a large company can actually do that, then nothing like it. Then it becomes a special opportunity. So I would say that, but at the same time, the downside of small companies is that these companies are vulnerable. Economic downturn or economic cyclicality or something which happens, which is either regulations or to the market or some such thing, the ability of the small company to withstand an economic shock or a business shock, which can happen even from a competition or a aggressive competition or a regulation or a change of weather or change of investor preference or customers preferences. So it can actually have a bearing on that, and we have seen that small companies can wither away. And small companies can potentially grow very fast, or they can be hurt badly. That is why, and so what we are witnessing, so they are not comparable situation. If you have a diversified portfolio of small companies, you are likely to do very well over a 10-year period, because the diversification, all companies will not go wrong. And assuming that the standard rule that some companies will do extremely well, a good number of companies will just be an average performer, or some of them will completely die, then still your money, the company which will do well will actually more than compensate for all the things that can happen, that can compensate for all the bad things that or average thing that happens to companies in your portfolio. As compared to that, a thematic fund is a big bet on a particular theme, whether it be consumer, whether it be rural India. We have seen many such themes. Infrastructure was one of the most prominent things which investors bought into. Likewise, you would have seen that the consumer, the Gen Next fund that we saw, this theme worked very nicely. So I would say that if themes work, they could be very rewarding. If themes don't work, or if you actually catch a theme at an inappropriate time, it could be very dangerous. Small caps can still do very well over a long period of time. It is not a theme. So this is what you should keep in mind. I think small caps and mid caps should be 20-30% of the portfolio, while I was talking about the cricket connection of your investments. Most thematic funds you can do without, because my understanding of an actively managed fund is that when you are entrusting your money to a multi-cap fund or a large cap fund, the fund manager will take that call.